Welcome to Unlocking the Investment Upside. I'm Geoff Robinson, founder of theinvestmentanalyst.com, and today we're diving into the cryptic world of sell-side downgrades. You've seen it. A glowing report ends with a neutral label and a trimmed price target, but what does it really mean?
Exactly, Geoff. The downgrade is rarely a simple, "we were wrong." So why do analysts wrap their capitulation in phrases like valuation concerns or execution risk? We're unpacking the language, the incentives, and what investors should really be reading between the lines.
Wall Street analysts use sell ratings on stocks less than 10% of the time. That's like having a teacher who refuses to give any grade lower than a B-. Today we're exploring the fascinating world of financial doublespeak and what it really means when analysts say a stock's valuation appears full.
That's a surprisingly low number. What's behind this reluctance to give negative ratings?
Well, it's all about self-preservation in a delicate ecosystem. These analysts have to maintain relationships with company management, keep institutional clients happy, and protect their careers. So instead of saying something's bad, they've developed this incredibly nuanced code language.
So they've essentially created their own diplomatic language to avoid conflict?
Exactly. Let me share my favorite example. When an analyst says valuation appears full, what they're really saying is, we completely missed the rally, and now we're trying to save face without admitting we were wrong.
That's like when someone describes food as interesting instead of saying it tastes terrible.
And here's another classic, and execution risk is rising. That's analysts speak for we've lost all faith in management, but we still need them to take our calls and invite us to investor days.
These euphemisms are getting more creative by the minute. What other examples have you found?
Oh, there are some real gems. Awaiting better visibility means we have no clue what's happening, but can't admit it. And risk reward is now balanced translates to the upside is gone, but we don't want to say sell and deal with the fallout.
That's quite a sophisticated way of avoiding direct criticism.
And we saw this play out dramatically with Snap Inc. in early 2022. Instead of saying this growth story is falling apart, analysts use phrases like challenging monetization environment amid macro uncertainty, while simultaneously slashing their user growth and revenue estimates.
So they were delivering bad news but wrapping it in layers of soft language.
Precisely, and sometimes this approach can have serious consequences. Look at Peloton in 2021 to 2022. While the company was experiencing fundamental structural problems, analysts kept using phrases like post-COVID normalization and transitory margin pressure, right up until the stock lost 70% of its value.
That kind of delayed recognition could really hurt investors who trust these opinions.
That's why sophisticated investors have developed methods to decode these messages. Some quant funds now use AI and natural language processing to analyze subtle changes in analyst language, essentially building digital BS detectors.
What specific patterns do these AI systems look for?
They track changes in adjective choice, shifts in how catalysts are described, and even the overall tone of conclusions, but there are also human-readable signs. Watch for big estimate cuts while maintaining a positive rating, or when previously mentioned bullish catalysts suddenly disappear from reports.
It's fascinating that markets have evolved this complex system of hidden signals.
Let's take a quick pause. Throughout my career in the city, I was ranked the #1 analyst by Institutional Investor 10 times, but I always believed institutional-grade investment knowledge should be accessible to everyone. That's why I built Insight One, a next-gen learning platform where deep market expertise meets interactive edtech. Whether you're new to investing or looking to sharpen your edge, Insight One makes complex investment concepts clear and actionable. Find us on the App Store, Google Play, or at theinvestmentanalyst.com. Insight One, learn like the pros. Anyway, back to it. And here's what's really interesting. Markets often respond more strongly to these subtle tone shifts than to actual ratings changes. A lukewarm neutral with pessimistic undertones can do more damage than an outright sell.
That seems counterintuitive. Why would a milder rating have more impact?
It's about credibility and context. When an analyst maintains a buy rating but starts peppering their report with cautious language, sophisticated investors see that as a sign something's seriously wrong. It's like when someone says, "I'm fine," through gritted teeth.
How do you think this might change as AI gets better at decoding these messages?
That's a fascinating question. As natural language processing becomes more sophisticated, analysts might be forced to be more direct. When machines can easily decode these subtle signals, the whole game of linguistic gymnastics might become pointless.
That could really transform how Wall Street communicates.
And let's not forget about the electric vehicle sector, another perfect example. When analysts started losing faith in companies like Lucid and Rivian, they talked about macro headwinds and capital expenditure discipline instead of addressing the real issues.
Those sound like reasonable concerns, though. What makes them euphemisms?
Well, in one telling case, an analyst cut their price target by 35%, but kept their rating unchanged. That's like saying, I think this restaurant's food is worth a third less than before, but I still recommend eating there.
That does seem like quite a contradiction.
And here's what I find most fascinating. This whole system is built on an unspoken understanding that everyone needs to read between the lines. It's like a complex dance where everyone knows the steps, but nobody acknowledges they're dancing.
So in a way, this coded language has become its own form of communication.
Exactly, and once you understand this code, you can never read financial analysis the same way again. Every balanced risk-reward and full valuation takes on new meaning. It's Wall Street's version of diplomatic immunity.
That's quite an education in financial communication you've given us today.
Indeed, and remember, the next time you read that an analyst is awaiting better visibility, what they're really saying is we're completely lost, but we're not ready to admit it yet. So that's it for this episode. Join us next Monday and every Monday for new insights from me and from James. Have a great week.